Welcome back to the Investment Conversation. I'm Lauren Ferry, Global Head of Alternatives Products at Lord Abbett. In our last episode, Steve Kuppenheimer, our Head of Private Investments, and I discussed how experienced lenders price risk and why disciplined underwriting is at the core of successful private credit investing. Today, we'll look at how those individual lending decisions come together in a portfolio and why portfolio and risk management are critical to overall investment outcomes. Steve, thanks for being here.
Thanks for having me.
Thinking about risks, not just at the loan level, but also at the portfolio level. Portfolio construction is really key. We've talked about software, like obviously sector allocation is important. When you are bringing these loans together, how do you think, like what's driving, what's the next loan you're going to make? What are you looking at in your existing portfolio?
So you're right. We're definitely looking at industry concentration. We're looking at issuer concentration. We're even looking at sponsor concentration.
Yeah, right.
To a degree. But now, we're now at a point where we're fairly diverse and scaled. So those tend to be, in most cases, those things are going to look okay. The next one loan you make is not going to dramatically change those numbers, but we still look at those. So I would say we're very much a bottoms-up investor. So I think I mentioned this a little bit earlier before, but being more direct about it, we're looking for a little bit of a Venn diagram and the overlap in the middle of, I would say, four main topics. And that's going to be industry. There, we're looking for less cyclical industries or counter-cyclical industries or industries with long-term tailwinds because we are making a 6 or 7 year loan that we cannot sell. So we have to assume there's a material economic cycle during our hold period.
Right.
So the industries that are going to, we consider ourselves largely industry agnostic, but there are certain industries that are going to not perform well when you're looking at a GFC, like when you're going to assume there's a GFC like event during your hold period. And those are your more highly cyclical industries. And then the second wheel or the second circle there is the quality of the company. Is it a market leader? Does it have a moat around its business? Is it growing? What are its margins? How does that compare to what they should be? Meaning we look at similar companies and how they're performing. Are they outperforming other companies with a similar business and is their business somewhat protected? Then we look at management. That's a key element that I don't know gets talked about enough. It's not just numbers. You need to know who is driving the bus and that they're very good. And when you think about this, I think it's more intuitive. You can have a great product, you can have a great company, but if the management is not strong, those things may be very temporary. And at the same time, great management can also steady the ship for a company that may be still growing or still establishing itself. So we focus on management maybe a little bit more than others that I'm aware of. So we're looking for tenure, proven effectiveness, relationship with the sponsor, how they work together, is there succession plan, things of that nature. And then the fourth circle on that Venn diagram would be ownership. And that is going to usually be meaning the private equity firm that owns them, but it could also be a family that owns them or a founder, or maybe there's not a control owner, but there's a group of private equity firms that own and not one of them controls it. But if it's a sponsor-owned company, you're looking for, a number of things. You're looking for what is the liquidity base of that private equity firm? Do they have more money to defend their position? If things get choppy, what is the historic performance of that private equity firm? Are they a good investor? Are they good at selecting companies? And then finally, what's that private equity firm's history and how he treats their lenders?
Right.
And there's been, I think, more news around that to focus on in the years since COVID than there was before.
Yeah, this is your comment before about not asking enough or not talked about enough triggered a thought, like if the roles were reversed, right, and you were the investor in a private credit fund strategy, like what questions would you be asking that manager?
I would want to know. I would want to talk about a few topics. So one, what is their strike zone? What is it that they look for, and how are they able to get it? What is their right to win?
When you say strike zone, what do you mean? Yeah.
Strike zone is some of what we talked about before, which is how do they define a good credit? And how do they define good pricing for the risk that they're taking? And then how do they make sure that they're able to achieve that? What is their right to win? What is their reason? What is the reason why these companies are going to borrow from them and not somebody else? And then I'd also want to go deep on their understanding of portfolio management, because this strategy is a long, illiquid, oftentimes moderately levered strategy.
Right.
So if you're looking at a BDC, you're really talking about investing in an operating finance company. It's not really just a fund.
Yeah.
It's a living and breathing company that has a lot of moving parts to it. The asset mix is one of those parts, but you need to know what's the board structure, who are the executives, how is that BDC owned and capitalized, what's their access to leverage, and how do they manage it. And those things often have a very material impact on returns, similar to the assets themselves.
Right. You brought up a bunch of points that I would love to double click on. One is leverage.
Yeah.
I imagine many in our audience, they hear that and they think it translates to risk. But I know in our conversations, we've always talked about how utilization of leverage means a more efficient portfolio outcome. So let's talk about that.
It's a balance of those things. So this is a strategy and asset class that historically has been levered very effectively. And so now let's take a big step back and call all of this senior secured corporate lending to U.S. companies. And if we, for a moment, look at the broadest context of that, you could look at CLOs, you could look at banks as kind of proxies for what we're talking about. So banks are in many ways pools of senior credit that are then levered. CLOs are pools of corporate loans, senior corporate loans that are then levered. And both of those structures are levered about 10 to 1. BDCs are levered about 1 to 1,
right,
or maybe 1.25 to 1. So it's much more modest leverage than this type of investing typically is subject to. And that's really for regulatory reasons. So BDCs are, I think, a very effectively regulated product. It requires an independent board of directors, public filings. So even if
there's a lot of transparency with
Correct.
BDCs, right, that you don't get elsewhere.
Correct. So even if you're a quote unquote, private BDC, you still make, all that means is your shares are not traded. You still make quarterly public filings that everybody can see. You still have an independent board of directors, and your leverage is limited to a regulatory max of 2 to 1. As a matter of conservatism, most BDCs don't really, and no BDC wants to operate right at 2 to 1 because that's too close to the limit. So you wind up operating 1 to 1 or 1.25 to 1 tends to be the target of most BDCs. So I start with that framing, Lauren, because that amount of leverage is very conservative for what the asset class is. And so in many ways, your ability to access and effectively deploy that pretty modest amount of leverage is a sign of the manager's capabilities around portfolio management. If we were talking about, if you look at the GFC, banks got to be levered 30 to 1. And now, in a post-GFC era, they've been way delevered, but still down to 10 to 1. So we're not really talking about nosebleed leverage or where the risk is hyper magnified.
Yeah, it's far from it, actually.
Correct.
Right.
You're talking about what is a intelligent way to kind of access this asset class to efficiently maximize returns without taking on too much risk.
Yeah. That's an interesting element of a BDC. You were discussing the NAV, the components of a NAV before, and also just buying like at par, below par, above par, like things move around. And I think that like we get a lot of questions about the movement in NAV for a BDC, what's driving it. If you look at historical returns of private credit through the BDC lens, they've been positive for every year for the last 15, 20 years. And you're like, how is that possible? Even through periods like the GFC, COVID, et cetera. The NAV can move around slightly, but it's really the yield, the distribution yield that's being generated. But how does the NAV move? Maybe we can talk about that.
Yeah.
We do field a lot of questions on that.
I think there's a lot going on here.
Yeah.
So I think what you're referring to is, the data for the asset class. Let's make it manager agnostic.
For sure.
The data for the asset class shows, a range of total return, meaning
Yes.
Realized losses adjusted for interest received or yield received, that's been positive. That's varied somewhere a low of 5%, a positive 5%
Yes.
in the GFC to a positive 12% at its peak.
I'm smiling. The
Yeah.
audience probably can't see me smiling, but I'm smiling because we also have, Steve was the CFO of a BDC. So he geeks out when it comes to
Yes.
the financial statements of BDCs and the calculations of the NAVs.
Yeah.
Yeah.
So I think that when you look at the NAV, what is going into it is independent. Again, going back to the regulation of BDCs, it requires independent valuation. So it's not the manager determining the value. You have an independent valuation firm who really will drive a tight range of values,
Right.
a valuation team that does work but is bound by that tight range. And then again, that's all submitted to an independent board of directors. But NAV changes come from, changes in the value from the independent valuation firm. And if you do have defaults or bankruptcies, then it's going to be held at like an assumed recovery value or eventually at a realized recovery value. So when you think about that valuation firm, what goes into those NAV calculations, there's two things that drive it primarily, and there's many things that drive it. I don't want to unfairly summarize it, but I'd say the two main drivers are, one, that company's performance. So we talked about earlier,
Right.
EBITDA growing or shrinking. So if a company's profitability is growing, it's going to either have stable value or increasing value. If it's shrinking, then that value, it will get marked down, be based on its specific performance, not relative to other companies, but its specific performance. And then the second most important input is, has the cost of risk changed? So if today we're in a market where, a spread of 500 is roughly the average, if we get into let's say if you look at COVID, what happened in the months immediately following the onset of COVID, the market widened out by about 100 or 150 basis points. It was something like that for a brief period of time. And so now let's say you've got a loan with 3 years left on it. The cost of risk is wider by 100 basis points. The valuation firm is going to ask you to mark that loan down by 3 points, 3 years times 100 basis points of widening. That's the second most important impact on NAV. So it's usually those are the driving forces of NAV.
Right. And then what has been the dynamics this year, would you say, broadly in terms of performance of the asset class?
So I think the dispersion you're seeing is, so first of all, again, we're seeing this period of dispersion that we have not seen in years. And I think it's been driven by a couple of factors. One is, we talked about vintage of loans.
Yep.
So I think, books that are more recent, that are cleaner, that were started when rates were already high and avoided asset-light industries like software, you're seeing those hold a lot of stability and perform very nicely. More vintage books that were ramped heavily during COVID or immediately post-COVID when rates were very low and asset-light industries like software were red hot. That's where you're seeing more issues and more valuation issues and more credit events. And then and then you have to look also at the specific strategy. Again, we talked about this earlier, of the manager. There really is differences between the portfolios and between the specific strategies. So if a manager is targeting larger companies, those loans, as we talked about, often come with more aggressive leverage, no covenants. They tend to be pickable. Those are things where value can erode more quickly than if in your more middle market companies where covenants are more common, PIK is less common, and value is retained more stably. And I think you were getting to this earlier, but the difference in recovery values when you look at a loan with covenants versus without covenants can be very dramatic. I think historically that difference can be as high as 20 or 30 points of recovery.
That's interesting. As you're talking about core middle market and upper middle market, what would you say, what segment of private credit has experienced the most movement from a credit risk perspective?
Well, I think it's definitely the large market.
Yeah.
I think then it gets called the upper middle market. These are just large companies.
Right.
They're not really middle market companies. To me, everyone asks what middle market means. They want to put a number on it. To me, it's a much more practical answer, which is, does that borrower have access
I knew you were
to
going
the
to say
liquid
that.
markets?
Yes.
I was going to fit that in.
Mhm.
So And large companies do have access
Mhm.
to the liquid markets, and smaller companies do not because they're not strong credits, just they're not large enough for the capital markets to care about them. And historically, that's been what's driven the outperformance of private credit is you're lending money to very good companies on a less competitive basis because you're not competing with liquid money. You get more spread against less leverage, more covenants, and you outperform. So that large market or upper middle market, which did not really exist in private form pre-COVID, that's where you have far fewer companies, far fewer sponsors. So you have a lot less choice and you have a lot less negotiating power because you're negotiating against liquid capital that's often 200 basis points cheaper
Right.
than your money. That's where I think you've seen more aggressive leverage, more aggressive documentation, that kind of, ramping during low rates in the post-COVID era, where you're seeing more of the risk sit.
Right. Last podcast we had Kearney and Vince. So Vince is on your
Yes.
team, and Kearney leads the public side for our loan team. And they talked a lot about convergence, just exactly what you were just hitting on,
Yes.
right? Upper middle market, large market, however you want to call it. I know how we like to call it. And when we think about Lord Abbett's research platform, and how does it help your team? Right, given access to Kearney's team and the public side, how does it help your team improve the outcomes for our clients?
So it's a huge benefit because we have that credit research team is over 30 people. They average over 20 years of experience. They're covering, 2,500 leverage finance credits, which is about the entire liquid market. And they're specialized by industry.
Yeah.
So what that means is we can look at a given private company and we can put it in context very quickly. And what I mean by that is let's say one of our deal teams is looking at a healthcare company that's $70 million of EBITDA, so a middle market company. They can go to the healthcare research team, the healthcare leverage finance research team, and they can show our deal team 5 companies that have a similar business plan, but maybe they're larger. And you can instantly compare growth rates, profit margins, regional distinctions, maybe pending regulation that would take us a while to uncover, who the good sponsors are in the space. All things that we could figure out if we were standalone, but it would take us much more time.
Right.
And so that context and depth is extremely impactful to us. They also can be the source of idea generation. They also have their own relationships with the street and some companies. And so what I'd say is, we as a firm, we've been in the leverage finance since 1971. There's very few firms that have been in leverage finance for that long. Right. There's very few firms that have existed for that long. And it is an enormous advantage for us. So as the liquid markets and private markets converge, having relevance across the liquid and private markets becomes its own differentiator, because you can see trends, you can see behaviors from both markets that make you better in the other one. And that results in better access to deal flow, more effective, deeper underwriting that's more efficient, and better outcomes for our clients.
You made a comment that sometimes they bring ideas to you, to your team.
Yes.
What my interest was piqued there.
Our first deal was a transaction for an insurance broker that was owned by a private equity firm that our team is extremely close with. But also the company itself was one that had historically issued both private and liquid debt.
Okay.
And we as a firm had been an investor in its liquid debt for years, and we're very close to the company, especially the CFO. And so as we were getting started as a private credit team, this private equity firm reached out, said, "We know you guys are getting started. We've got a great credit that's oversubscribed, but we will fit you in because we want to kind of grow with you." And at a day later, the CFO of the company called our lead research analyst for the space with a similar message saying, "I know you guys are getting into the private side. We have this private loan that's oversubscribed, but you've been a good investor with us for years, so we'll fit you in." And there's a great kind of anecdote around the kind of joint relevance, or maybe the magnifying our relevance in the market because of our historic relationships. And I think, as Kearney and Vince said, that works both ways. We as a team are talking to private equity firms every day, and they like to have less conversations with firms that can provide both liquid and private solutions. And so it's not uncommon for us to get ahead of a liquid opportunity and to share that with the liquid team. And it's not uncommon for us to use the research that they have, as we just talked about, to your point, in a way that gets us a lot deeper, a lot faster.
Yeah, that makes total sense. It's much more efficient from a sponsor coverage perspective, of us. All right, so one last question for you. So what is one risk factor in private credit that you think the market is underpricing right now?
Well, I think it's we covered a lot today, and I don't know that there's anything that I would say that I haven't said already. So maybe I'll highlight just a couple of those points. One, and this is always the case, you said right now, and so I'll get back to right now, but I think historically my answer to this question gets to that portfolio management point. I think that investors often want to talk about individual credits and how you access those, but it's really important to understand the structure you're investing in. And that brings another dynamic to the table about how leverage is used, the manager's ability to do that. Are they matching assets and liabilities so there's not a liquidity issue? What is the overall approach to diversity? Those are questions that I think historically get asked less, that I think are very impactful. If you were to look at things today, I do think it's this difference around vintage.
Yeah.
So I think that when we talk about vintages, and we always lose sight of the implicit joke there, we talk about like it's wine. And the truth behind that is market conditions for lending change over time. And for some quarters, some years, they can be more borrower friendly. And for some periods of time, they're more lender friendly. So I would say we're in a period where we're reaching the maturity date of a period of time, that 2020 to 22 period, where they were more borrower friendly conditions. In other words, more aggressive lending with lower base rates. And if you look at where we've been for the last couple of years, it's been more lender friendly, higher base rates, which means more conservative lending overall. And now you're seeing a pullback in capital because of the redemptions in some of the larger, more vintage BDCs. And that's resulting in a less competitive investing environment, which means we can get better terms. So I think that vintage dynamic is probably the other one I'd point out, and it is more timely.
Right. That makes complete sense. Yeah. Thank you for listening to the Investment Conversation. Find more episodes on LordAbbett.com or wherever you get your podcasts. And follow us on LinkedIn, Instagram, and YouTube for more perspectives across the firm.